If you have been tracking the Indian equity markets recently, you know that mid and small cap stocks have experienced intense volatility. During such phases, holding underperforming funds hurts twice over. You miss out on the upside rallies while suffering steeper drawdowns during the market drops. Few schemes highlight this dilemma better than the PGIM India Midcap Fund. After a brief surge in 2020 and 2021, the scheme has legged its benchmark across 1, 3, and 5 years horizon. Today, we will look at the facts to see why holding this fund any longer may be costing you significant returns or whether it is worth waiting for a turnaround. So now let's start the video with the basic details of this fund. First, its total asset under management, that is the AUM, which stands at approximately 10,981 crores, which is on the lower side as compared to other funds in its category. Meanwhile, its expense ratio is 0.48%, which is at par with the category peers. The scheme's reference benchmark index is Nifty Midcap 150 TRI. Now let's examine the fund's portfolio, starting with its sector allocation. The PGIM India Midcap Fund allocates its portfolio preliminary across financials, that is 23%, industrials, 18%, consumer discretionaries, that is 13.5%, healthcare, 11.5%, materials, 9%, and technology, 6.5%, along with smaller stakes in consumer staples, real estate, energy, and utilities. Relative to its benchmark, the fund maintains active overweight positions in industrial, consumer discretionaries, and healthcare, while remaining underweight in financials, technology, energy, and utilities. Outperforming sectors like industrial, healthcare, and consumer discretionaries have provided strong support driven by domestic capex and demand. However, the fund's underweight stance on surging utility sectors has limited its ability to capture full market momentum, resulting in a balanced yet restricted growth profile. Now let's review its top holding and overall asset allocation. The fund's top holding features Federal Bank, that is 2.61%, Uno Minda, Mankind Pharma, followed by Bharti Hexacon, Aditya Birla Capital, Prestige Estates, AU Small Finance Bank, Max Financials, Vishal Megamart, JK Cement, and BSE. Its primary exposure remains heavily concentrated in financial, industrial, and consumer discretionaries, which collectively make up over half of the entire portfolio. Looking at the market capitalization, the portfolio is anchored predominantly by mid-cap stocks at 69.68%, aligning with its core mandate. Large-cap stocks account for 21.12%, significantly higher than the category average of 13.93%, offering added portfolio stability, while small-cap stocks comprise 9.20%, below the category average of 12.05%. The average market cap of the portfolio stands at 74,886 crores. From a concentration standpoint, the fund is broadly diversified across 107 stocks, with its top 10 stocks accounting for just 21.72% and its top 5 holdings 12.01%. However, its top 3 sector hold a combined weight of 54.92%, with a portfolio PE ratio of 34.99 and a PB ratio of 5.25. The fund clearly follows a growth-oriented style, favoring companies with premium valuation and high expansion potential while mitigating single stock risk through broad diversification. Now let's check the key portfolio changes made over the past 1 month. During the month, the fund strategically rotated capital by initiating new positions in Bharat Heavy Electricals Limited, that is BHEL, Polycab India Limited, Interglobal Aviation, that is Indigo, and Acme Solar Holdings, alongside increasing its stake in MCX also. To fund this addition, it fully exited high valuation momentum players like PB Fintech Limited, Suzlon Energy, while trimming its position in Cholamandalam Finance Holdings and ICICI Prudential AMC, and also from Tube Investments of India Limited. By reallocating capital from stretch fintech and auto ancillaries, valuation into domestic infrastructure, power ancillaries, and market monopolies, the management aims to lower overall valuation risk and capture long-term structural capex growth. This realignment positions the fund to benefit from rising industrial order books and expanding market volumes. Though near-term success will depend on earning execution across these newly added holdings. Now let's look at the fund's trailing returns. The trailing returns reveal a clear pattern of sustained short to medium term underperformance by the PGIM India Midcap Direct Fund, highlight a significant lag against both its benchmark, that is, BSE Midcap 150 TRI and its category peers. Over the 1 year horizon, the fund generated a dismal 4.16% return compared to 10.7 by the benchmark and 11.8 by the category average, ranking near the bottom. This substantial lag persists across the 3-year and 5-year windows, placing it in its lower quartile, while the long-term metric shows slight relief, notably at 7 years mark, 24.33% versus 23.19% benchmark, ranked 7 out of 23. The 10-year returns of 16.87 merely sits in line with the benchmark's 17.36 without delivering meaningful alpha. Overall, outside of a brief historical sweet spot at 7 years mark, the fund's performance remains distinctly poor, weighed down by severe underperformance in recent cycles. Now let's look at the calendar returns. An analysis of historical calendar returns highlight a distinct phase shift in the fund's relative performance over the past decade. During the 2020 and 2021 post-pandemic mid-cap rally, the fund delivered standout performance, generating massive returns of approximately 51% in 2020 and 67% in 2021, significantly outstripping both the BSE 150 Midcap TRI index and the category averages. However, since 2020, the fund has consistently struggled to maintain that momentum, underperforming during market upswings, most notably in 2023 and 2024, while registering flat performance in 2025. Amongst a modest year for the mid-cap space, the fund barely scraped positive territory at approximately 1% against lagging the benchmarks around 3% returns and category average. The key takeaway is that while the fund exhibits strong upside capture during aggressive, liquidity-driven bull runs, it suffers from pronounced inconsistency and sustained tracking lag in broader consolidation phases, making its overall trajectory highly cyclical and uneven over time. Now let's check the fund's performance over last 12 months. The monthly trajectory over the last 12 months, that is August 2025 to July 2026, reveals that PGIM India Midcap Fund tracked its benchmark and category average closely, albeit with frequent downside leakage during positive market swings. Major market corrections were evenly matched across the board, most notably in March of 2026, where the fund declined by approximately 10.5% in tandem with the benchmark, followed by a sharp recovery in April of 2026, capturing 11.5 versus approximately 12.6 from the index. The fund demonstrated localized alpha in select positive months, outperforming in February of 2026 and June of 2026, while offering slightly better downside protection in negative months like August of 2025 and December of 2025. The main lesson here is that while the fund aligns well during swift market rebounds, it slightly lags during the broader market advances, continues to drag down its cumulative trailing 1 year performance. Now let's quickly examine the rolling returns. Here we have rolling returns data across 1 year, 3 year and 5 years period. Let's evaluate each horizon separately. The 1 year rolling returns show that PGIM India Midcap Fund delivers a solid historical average return of 19.84%, generating returns about 20% nearly 37.6% of times. However, the consistency remains a coin toss as it beats the Nifty Midcap 150 benchmark only 50.40 times, displaying significant volatility, that is 27.50 of standard deviation, and a noticeable drop below the benchmark curve in recent years. Over a 3-year rolling horizon, the fund maintains a healthy average return of 18.38%, delivering double-digit returns of 72.59% of times. However, benchmark consistency is weak. It beats its index only 41.75% of times, driven by a sharp performance breakdown and a steady gap beneath the index line post 2023. Over a 5-year rolling time frame, the fund demonstrates strong historical long-term consistency, outperforming its index 66.69% of times with a high average return of 18.70% and a minimal downside risk, negative returns occurring just 0.60% of times. However, the data shows that while it built a substantial relative outperformance between 2020 and 2023, its performance trajectory has deteriorated significantly post 2024, crossing below the benchmark index in recent years. Overall, the PGIM India Midcap Fund exhibits severe short to medium term underperformance alongside deteriorating benchmark consistency over 1 year, 3-year, and 5-year trailing horizons. The fund heavily lags the BSE 150 Midcap TRI, delivering 4.16% versus 10.70% in 1 year, 13.07% versus 18.48% in 3 years, and 12.61% versus 17.04% in 5-year time frame. With only its 7-year returns, that is 24.33% versus 23.19%, shows a notable alpha. Historical calendar trends highlight a sharp phase shift, while funds generate a massive outperformance during the 2020 and 2021 bull run. It trailed significantly in 23, 24, and 2025 across the last 12 months, despite capturing sharp market rebounds, that is, in April of 2026. Steady minor leakage during upswings kept cumulative returns flat. This structural drag is further reinforced by rolling returns. Its 1-year rolling bid rate against the Nifty Midcap 150 sits at just 50.40%. Its 3-year rate falls at a week of 41.75%, followed by a steep post 2023 divergence, and its historical strong 5-year rolling trajectory has crossed below the benchmark in recent years. Now let's look at the fund managers. The management transition from Mr. Anirudh Naha to Mr. Vinay Paharia in April 2023 mark a clear structural shift from aggressive momentum chasing to a conservative growth at a reasonable price, that is, a GARP strategy. While this process-driven approach, supported by co-managers Mr. Utsav Mehta and Mr. Vivek Sharma, broadened diversification to 107 stocks to manage the risk, the fund's performance has been distinctively poor since the takeover. By rotating away from high momentum cyclical play into slower compounding quality bets, the fund underperformed significantly across 2023, 2024, and 2025, leading to a severe 1-year and 3-year trailing lags. Overall, Mr. Paharia's risk-averse restructuring has so far failed to generate the alpha, leaving the fund severely lagging behind both its benchmark and the mid-cap category peers. So before concluding with the actionable advice for investors, let's quickly look at the fund's risk parameters. Here is how the fund's updated risk parameters compare against its benchmark index and the category average. First, the mean return. The fund's average annualized return stands at 13.18%, which is significantly lower than both the category average and the benchmark index. Here, higher the value is better. Second, standard deviation. Measuring deviations from the mean returns, the fund stands at 16.18%. This is lower than both the category average and the benchmark index, indicating lower absolute price volatility. Here also, lower is better. Third one, Sharpe ratio, measuring risk-adjusted returns. The fund scores 0.46. This is noticeably lower than both the benchmark index and the category average, reflecting poor compensation for the risk taken. Here, higher the value is better. Fourth one, beta, measuring relative volatility against the benchmark. The fund sits at 0.86. This is lower than the category average, indicating the fund fluctuates less than the broader market during the swings. Here, lower the value is better. Fifth one, alpha. It is the measuring excess performance generated over the market benchmark. The fund stands at minus 3.24%, severely trailing the positive category average of 1.15% and highlighting significant underperformance due to weak stock selection. Here, higher the value is always better. From these risk parameters, we can conclude that while the fund exhibits lower absolute volatility, the market sensitivity, that is, lower standard deviation and beta, it suffers from a severe underperformance, delivering significantly lower returns, a weak risk-adjusted profile, and a negative alpha compared to both its benchmark and its peers. Now let's examine the upside and the downside capture ratios. Here is the comparison of capture ratios and drawdown metrics based on the updated data. First, the upside capture ratio, measuring performance relative to the index during the market advances. The fund stands at 77. This indicates it's captured only 77% of the index gains, underperforming by 23% during the market rallies, well below the category average of 95. Here, higher the value is better and ideally should be more than 100. Second, the downside capture ratio. So measuring during the market declines. The fund stands at 86. This indicates it's dropped 86% compared to the index during the market fall, offering better downside protection than the category average of 93. Here, lower the value is better. The maximum drawdown representing peak to tough loss. The fund recorded a maximum drawdown of minus 18.14%, occurring between October 1st, 2024 and February 28 of 2025 over a 5 months duration. This is slightly better than both the index, that is minus 18.62%, and the category average of minus 20.62%. From this matrix, we can conclude that while the fund provides decent downside cushion and slightly lower drawdown during correction, its low upside capture ratio of 77 severely restricts its ability to participate in bull runs, leading to noticeable performance lags during the uptrending markets. So now let's move to the conclusion and discuss what investors should do next. But before we conclude and go over the final action plan, if you have found this analysis helpful so far, please hit the like button and subscribe to my channel if you haven't already done, so you don't miss further market insights. Please note that this video is strictly for educational purpose only and reflects my real analysis of the data. It should not be taken as a direct buy or a sell recommendation. Please make your own decisions or consult your financial advisor before taking any action. Now let's look at what investors should do. First, for the existing investors, given the fund's persistent multi-year underperformance, highlighted by a 3-year CAGR of 13.07% versus 18.48% for the benchmark, and a 5-year CAGR of 12.61% versus 17.04%, holding this scheme indefinitely creates a significant portfolio drag and a high opportunity cost. Investors should consider pausing active SIPs and step-ups immediately, redirecting fresh monthly inflows toward consistent category performance or low-cost index options. To exit the existing corpus, a phased approach using a systematic transfer or withdrawal strategy over 2 to 3 months is advisable rather than waiting for an uncertain recovery, while utilizing annual tax-free long-term capital gains threshold across financial years to minimize tax liabilities. For new investors, prospective investors should avoid initiating fresh allocation in this fund due to its weak risk-adjusted profile and poor upside participation. With a negative alpha of 3.24%, a Sharpe ratio of 0.46 compared to the category average of 0.74, and an upside capture ratio of only 77. The scheme fails to deliver adequate risk-adjusted outperformance during the market advances. Instead, capital is better deployed toward established category peers and consistently generating positive alpha and demonstrate strong upside capture or low-cost passive index alternatives. This is my personal perspective based on current data, and market dynamics can always evolve. What are your thoughts on this fund? Please share your views in the comment sections below. I would love to know what you think. As a quick personal update, I currently do not hold PGIM India Midcap fund in my portfolio, having exited the scheme about 6 months ago. I will review this fund again in another 6 to 7 months to check on its performance trajectory, so stay tuned to my channel. Please hit the like button, subscribe to the channel, and check out my previous video links in the cards on the screen. Thank you for watching, and I will see you in my next video. Thank you.